see it's negative 61.8.
Mm-hmm.
It's going to be there. It's going to show up. Yeah, since it's negative, I'll just leave it where it is.
Alright. And then can you pull up a clean chart and demonstrate on how to use the retracement tool?
Okay, so let's go grab that chart. Come up. Go to analysis. Clean chart.
Mm-hmm.
And then you want me to put the retracement tool on this guy.
Yeah, so show me how you'd use it and how it would work to your advantage.
Never mind. Okay. That was yesterday when we were doing this. I was wondering what wants to go. All right, click just a second.
You're good.
Okay. Yeah. So let's.
If you actually hit it somewhere that you don't want, you can just right click and it will take it away before you left click it twice.
Okay. Actually, that's not where I want to go either. Sorry. But click it twice, it goes away. So this is the real trick, is figuring out where do you want to put it.
Yep.
Okay. That's what I like. That point right there. Oh, I see what I did. Okay, no, actually, we'll just do that. Stop it. Okay. Yeah, all right, just a second. I'll figure this out.
No, you're good. No worries.
Yeah, here we go. So then, isn't there a delete on that one?
Yep.
Why not see that? And snap. Copy. Maybe I'll just break it like that. All right, we'll just go brute force. We'll get one more. Okay, I think I got it this time.
Okay.
So we're gonna that point right there. Oh, so we should have picked something in the middle, maybe. Okay, all right. And that's not where I want it. But
That works.
that'll work.
So, let me do a little adjustment on this one.
Okay.
Do you see the little thing saying, "Are you having sound problems?"
Yes, I do.
Is there any way to get that off the screen so I can see the bottom there? I don't know if I can. How I do that.
Um, there we go. Okay. It was a message, that's all.
Gotcha.
All right.
Okay. So on these, you generally want to have them snapped to different. So if you snap to the body right here at the bottom of the body on this candle, you generally want to have it snapped to another candle. And what it usually is going to measure is a run up or a run down. And so let me, I'm going to move this one real quick. So let me right click up here, and I'm going to hit adjust the drawing, and I'm going to adjust that one side. So I'm going to put it over here. So if you look where we're at, this run up, you saw that it retraced the 38.2% on the dot, right there.
Okay.
And now it's sitting right on that.
Okay.
If we wanted to try it again, we can do something like the bottom here. From this guy, we can go to the top of, oops, retracement, there we go. From the bottom of this one, we can go to the top of this one, and you can see, again, this guy sat right on the 38, this sat on the 38, this went down to the 23, went through that, played with the 50, and as you can go back, went to the top, and then just started playing in these ranges, but using these lines literally as support and resistance. So they were respecting these lines as they would go through. Even back here, we're looking at respecting the 50% line. So what's neat about this is you have, let's see, 20 hours worth of data that then gave you 9 days worth of support and resistance lines.
So in this case, we're looking. So we had a large move one direction or another,
Mm-hmm.
and then we used that to establish what the new, like I say, the support and resistance.
Yep. So it gives us support and resistance lines that are respected by the market, and points where the market will go to and respect and bounce from those points, bounce from the top, go down, try to go through 38, not play between the 23 and the 38, shoot back up, come back down, hit the 50, play on the 50, go through the 50, hit the 61, hit the 50 again, go through the 61, play between the 50s and the 60s and the 70s, sit on the 70s, touch the 61, sit on the 61, touch the 70s, go through the 70s, now use it as like a ceiling for all of these, go through it again, and play up here with the 50s. So it's just like, it keeps turning these lines into another ceiling or another floor. But it gave me 9 days worth of that information, and this is still valid moving forward. Yeah, let me customize this guy real quick. Green's a little bit hard to see. Let's use black. So let's see, erase that one. And erase that one. Yep, there we go. It's just a little bit nicer to see. So there's your 9 days of additional information being projected from this. So, well, it looks like you've learned how to switch pairs out. You went to from the Euro USD to a Australian dollar USD.
Yeah, and playing around a little bit.
Nice. Let's look at Slack real quick. All right. Oh. Okay. So let's move to our trades we placed and look why they filled or why they did not fill. Alright. Grab this and move this. Okay. So we've got the trade we put for the sell.
Yeah, those first two are just ones that when I was opening the tool, just practicing, so you can use the bottom two are the ones you care about.
Okay. So let me.
I realize I still had them open either.
That's fine.
Just don't want to.
Come on. There's. Alright. Okay, so this one we opened to begin with, and then we opened both of these right here because I wanted to work our way out of a negative trade. And then also give you some solutions on what to do with this positive trade. But this is the one we took for a sell. As we go back over to green chart, we can see, let's see, right,
Right there.
right,
Never mind. Just ignore me.
there you go. Let's see, did we have, so I put in some, remember I typed them in. So we went for 3.7 pips long, so, and then we went for 14.4 pips short.
So it's on a 240 chart. Yeah, that's it right there.
So this one, yeah, as you can see, it is playing within this range still, but it's come up. So let's look at, because I wrote it in, so, but this was the area right here. So we took our trade, I should have put an X there. I believe it was right in this range right here.
Yeah, I think so.
So let me add another tool to your toolbar. Let's go to marker. Okay. So I think it was right here. We got in. And if we measure that, let's see where we were at. We got an 11,488. So this line right here, let's change the properties to show, label this and show price. Hit OK. It's 11,484. So just right above this point is when we got in. And then it moved down to our first resistance level and just didn't go past it, which was a very strong resistance level from here. From here we had these points. And one of the things that I was a little bit concerned about, and I want to go over, because we only got 9.5 off of that instead of the 14.4 we were looking for. So we were positive during this, we just didn't get it. And then it just went away from us. So let's go over some options that we have on when we're in a positive situation, what we can do to make it not run against us like this. But also looking at this is just the 1 hour. Remember how we were talking about the how to tell if a trend has changed direction?
I don't remember you and I talking about it.
Okay, so this might bring something back, but we were talking about higher highs and higher lows.
Okay.
Okay. So what happened was this trend was, you had a lower low than previously up here, and now you had a lower high than what was over here, and now you had a kind of lower low, kind of even, but the high was lower than here, and then it went to a lower low. And then after this point, we went to a higher high than right there. I was thinking this was more of the higher high, but it changed, and then we never had another low that was lower than this point. So this was the expectation that this would go past this and create another lower low, but the market has, in a sense, changed direction. So from this point right here, we are moving, and let me add another tool. Oops. It's called, there it is. Okay, it's a zigzag tool. Let's just change it to black for right now. So what had happened was I was wanting, let's thicken this guy up. Alright, okay, let's use it. So what I was wanting is for this to come down and to create a lower low. Because we were seeing from this point here, we came down, had a lower low, came up, had a lower high, came down, and eventually had a lower low, came up, had a lower high, but we didn't come down, to show that we would have a continuation in the downward trend. But instead it reversed right here off of some very strong resistance lines, as we're looking right here. Oops. Let's adjust this to there. And we went from there. So we created a new higher low and a new higher high, and then I was thinking that this little dip wasn't that situation, that we were just creating an opportunity to come back down, but we kicked ourselves out of it. So here we created a higher high and then, or a higher low, and then it went to a higher high. So if I can adjust this here, let's go down to the bottom of this. Let me adjust this one here. Adjust. Okay. So this pattern, and it's kind of hard sometimes to get the exacts on where these happen, because, for instance, this is the lower low, and this could be the higher high. Now this is the lower low. But this lower low really didn't go lower than over here. So it was kind of a confusing. So I just used the next lower low. So what we're looking for is this pattern going down, up, further down. The up wasn't as high, like you had these planes here. So here, this is your high, here's your next high. This was the next high in this area. This was the one after that. But then we created a new one. This was created before we took our trade, so we should have taken this into effect, but we didn't, and that was my bad.
Yeah, when we were doing it, there was down pressure following that. You can see we were coming off the up.
Exactly. No, so we can go back and actually look at that as well. So let's go file. Let's look at the simple Euro USD. That'll load here in a second. So let's minimize and go back in history. So what I'm going to do is I'm actually going to show you a technique on how to link all these so they all move in the same direction. So I'm going to go to chart settings, right click, go to chart settings, go over here to advanced settings 2. The link number is going to be 1, and I'm going to do bar period, or sorry, scroll position. And apply, OK. Come on. Okay. And I'm going to continue to do it for these 5 charts right here. And the additional charts we have on the 60 and the 240, those are for drawing in this chart book. So we'll just leave those outside of this. So we won't link those. So that's setting 2. Go to link chart 1. Again, scroll position. Hit apply and OK. And I'll have you finish the next 3 with the same sequence.
Okay. And so what are we doing? What are we doing to link these?
So you're going to the thing itself, and you're not clicking down here, but you're in the actual screen. You're just right clicking, go down to chart settings. You're clicking on chart settings, and then advanced settings 2. You're doing the link number down to 1, and then you're hitting the scroll position.
Okay, and so the number 1 is what links them together?
Yep, that's the link number. So you can have other ones linked separately. So if you want the larger charts linked and the smaller charts linked, you can do so. But for right now, let's just link all of them together.
Okay. Okay.
Alright. So what this does is it lets me take one of these and I can go back and they all follow in suit. So let's go back to the time when we had the pressure and they were all together, which would have been let's see. If the pressure was tighter. Let's see where we were at. When we took this trade, it was at 1912. So let's look at 19 hour yesterday. Alright, so right, it was this one right here, wasn't it?
15, right?
So this was the bottom right there, because it took the price at let's see, it was at 11488. So right here, 11488. So we were in this candle, and as we move forward, we can move forward because we got pressure down, pressure down, pressure down. This one kinked and pressure down in a day. So pressure was down on every single one of these, but we just had a very hard resistance level to go up against, and we didn't quite make it. But if we move forward in the 5-minute, we can kind of see how these, in the next little bit, we saw that the 30-minute double crossed. 5 had gone up and down a little bit here. It had gone from the oversold area all the way to the overbought area, which is normal for a 5. But it stayed a lot in that higher range. And if we continue moving forward, we had our down candle right here that would have, oops, so here's our prices, no, would have been, where's 11,448, okay, we might have one more candle that went further down, there it is. So here to here was the 8.3 or so that we got. If we go further, one more candle, yep, so we had about 8.3 pips that we were up, but it didn't close from our 14, and then it went against us. And so pressure reversed in that period of time, really based upon that support line, because you saw the 30 kink, the 60 kinked, and the 240 started to move over itself. There was the kink right there on the 240. So they all changed directions right after that, and one of the things that we should have looked at would have been something like this. And instead of trying to go for an additional support line down here, taking the support line we had that was very respected here, and using that support line with more confidence, because that's where it bounced. Because if we would have just taken to that support line, we would have gotten out of that trade. Pressure, again, was a little bit deceiving on that one, but this is where we look at multiple ways of analyzing, and the biggest key on this one would have been seeing that we had created a lower high but a higher low, and then a new higher high than our previous high. And then we didn't move this down into creating a new lower low, which would have been down in this range. And so this was, we were up 8 pips on it. It went in our favor for 8 pips, but then turned around. And so what I'm going to start showing you right now is what you can do if you were to monitor that and and see yourself up on this trade right here. So we have this trade right here. We're up 28 pips. So one of the things you can do is, if you think this is going to continue in that direction, let me increase this guy right here. Okay. Let me go to a 1 hour chart. If you think this is going to continue in this direction, this buy right up here, and we're creating our new higher highs, higher lows, higher highs, higher lows, higher highs, what we have is a few different tools at our disposal. So instead of taking this buy, because one of the things that Kevin, the guy who you're a pro funded, correct?
Yeah, whatever, it's the 3rd level. Is that?
So you're an executive?
No. So whatever, the 60%.
Gotcha. Okay, the pro funded. So you'll receive a funded account at the end of this. So with the funded account, I'm just going to give you ideas that Kevin has shared, and he's the one who funds the account, and he's the one who looks at funding additional amounts every 3 months later. And so one of the things that he looks at is, he likes to say, I would like to see people cut their losers short and let their winners run. And so by that, because we have a lot of the mentality in the company is put a stop loss in place, let it kick you out, or you can hedge it, and we'll get into hedging a little bit later. But what we don't really do is we don't let our winners run very much. We like to just take profit, and that's that. So what I'm going to do is I'm going to show you on this buy that we have right here, I'm going to, instead of closing it out like we have right here, I'm going to show you a few different options. One of the options, we can right click and we can do a trailing stop. Meaning, are you familiar with what a trailing stop is?
Yeah, so this is, so I've made my profit.
Mm-hmm.
So it's a stop, but so now it's a stop loss, but it's still in positive territory. So in other words, I made my gain, and I want to make sure I don't lose that gain. So I'll get out of the trade if the market starts reversing on me.
Yep. And so this is one method to use. And what you do is you come in here, hit a trailing stop. These are micro points. So when it says 1.5 points, that's 1.5 pips. That's a very, very, very small move. So I usually customize this button because those are pretty deceiving, because they're not full pips, they're micro pips. And that's why they say points on here. So I go to custom, and let me ask you the question. How many pips, because we're up 31 pips right now, how many pips are you okay this coming back to take you out, but allowing enough breathing room for it to continue up if it's going to continue up?
Yeah. So just just looking at the chart
Mm-hmm.
in the short amount of time, this is a 1 hour chart, right?
Yes.
Okay, so just looking at it, I would say it looks like we created kind of a support level at right where your arrow is right now.
Mm-hmm.
So we come there twice, or we come down to I guess we won't come down to it once. We come up. So that's the first time we come down to it.
Mm-hmm.
So that's where I would. If it goes below that support, that's where I would put the stop.
Okay. So what I'm going to do is I'm going to put a line right. Come on, line. I'll put a line right in there.
Yeah.
All right, and then I'm also going to give you another suggestion.
Okay.
On top of this one, you may want to put a line right there.
Okay.
And what I mean by that is we've seen the price travel almost to this point, but never get past this point. So this might be more breathing room to where if it came down, it would be a full market correction. So instead of going higher high, higher low, higher high, it would have to create an absolute lower low instead of a new higher low. So it would have to come all the way down to this point, going below these guys, because this needle is way high. I mean, if you get something like this, like a needle like this one right here, this wick, in the opposite direction, you could easily pierce through this thing, but not necessarily past these points.
Okay.
And so I'm just throwing out additional ideas, but down here seems a little bit safer. You still have a decent buffer of profit that's available if the whole thing reverses. The one thing when you're in a profitable trade you don't want to do is feel like you're losing anything, because there's nothing you're losing. You're just not taking as much off the table. But what you're doing is you're letting your winner run for a further distance if you have this kind of breathing room down here. And the downside of a trailing stop is this line is going to move up constantly as this price moves up. So as the price moves up, this line will just constantly bump itself up all the time until that price starts moving down, and then it stops wherever it's at, and then it'll kick itself out if it hits that point. So sometimes people like to put hard. They like to do what's called a manual trailing stop, where they just put a stop loss. They move a stop loss up into a profitable position. So they manually put it in this place, where a trailing stop would continue moving it up out of the range that you feel comfortable. So either here in this line where you were saying, or here in this line where what I was suggesting, and they would place a line that would allow them, or a stop loss that would allow them the exact place they want without it moving. And then when it adjusts and moves up, you continue to manually move that trailing stop up into positions you want versus what the trailing stop itself does.
Okay.
So some pros and cons.
So the trailing stop then automatically shifts in the direction of your trade, but doesn't retreat. Is that right?
Yes. So let me just put a trailing stop on here just for a demonstration. Let's just say, let's do it custom, and let's just do 150, so 15 pips. I'm going to hit OK. And that was my buy. And this is that line right, that little dotted line right there is it. So it's right below where you're at, so that's 15 pips. But right now it's at 11,657. And then if this moves up, 11,660. So it just moved up. Instead of 657, I went to 660. So it's constantly going to move up as this goes up. And now that little line is above your line that you were saying. And it's just going to continue moving up until... and the one thing about a trailing stop is you have to have your computer open and running with this in place.
Okay.
So you can't close this application down, because once you close the application down, the trailing stop no longer is there.
Okay.
It won't move it up anymore. It'll just keep it wherever that price is where you close down. So you're moving it up right now?
Right.
So that's the pro of this is it follows it up, but the downside is it can get you into an area that you may not be comfortable. Like right now, you're up above an area that you even said you wanted to be at. That's 15 pips. So there's alternatives like the idea where you have the trailing or the manual trailing stop. There's also another possibility to where some people will say, hey, you know, I like this. I've got 30 pips. Let me take half of that and put a 1 pip take profit or a 1 pip profitable stop loss. So 1 pip above where the buy is. So somewhere in this area right here, bring my stop loss up to somewhere in this line. I already took half of my profit off the table. I've closed half the trade out, and I have a stop loss that's so far down that it has so much breathing room that it literally can do whatever it wants. And if it continues, awesome. If it comes down and hits me, I already got half my profit out. I'm already done. I've already made my profit, and I can't lose on this trade now.
So I can sell a portion then of my trade then.
Correct.
Okay, now how do I do that again?
So to sell a portion, we're going to right click on that trade. I'm going to go to modify and delete the order, or delete the order. And be very careful because I've accidentally come up here and going too fast, hit close order, which just closed the whole thing out. So be very careful because they're very close to each other, which I don't like. But
close order means that we just sell it. Is that right?
Yep. Wherever it's at, it's sold.
Okay.
It's closed. So
yeah,
we're just closing that position in that wherever that profit or loss might be.
Okay.
So here we're going to modify. Normally we come in here to modify to put a stop loss in or to put a take profit in, but you can also come up here under type order and you can go to market execution. And now I have this close button that's available to me, but I can also change and alter my volume. So I can close this out right there. And it says right here, close this buy trade at this lot size in the market. And so I can close out half of that. Like right now I could close out half of it, bank, $15 or so. Half of my commissions would go away, so I would be 60 cents instead of 60 cents. The remainder would be 30 cents because half of the commissions go to this side. And so I could take that 30 cents, I remove 30 cents from this. My swaps are negative right now, so it's going to be more like 80 cents. So I have 30 cents here, and I'll have 10 or 11 cents left here. Both being negative, so I'm going to have a negative 40 cents. But what I've done is I've given myself the opportunity to let this thing run. And I've given myself more breathing room than before. And usually you would do this a little bit sooner. So for instance, when we were trading previously, and we put that sell in, and it came down. So this guy right in here, let me close this out. When we put that trade in, and it went from our line right here. Oops. I want to draw a line. Come on, draw a line. From this area, why would I draw a line? I guess I gotta hold it down. Alright, so from that area down to here, this downward move that from our lowest sell, which was the first one up here, 11,488, because the other one was right next to this one because we placed the buy and the sell at the exact same time, so a second apart on those two, and this was 8 minutes previous. But this downward movement, we had 8 pips or 9 pips that we were up on this, and so what we could have done is closed out half of that position, put the 1 pip in, and then when that came back and hit that, it would have kicked us out, and we would have had our 4.5 pips technically on it because we would have taken half of it. We would have closed out half that position, and then we would have had an additional 1 pip on that other half of the area that would have covered the commission. And so there would have been no loss on either one of those. The first half we closed out, we would have been profitable. The second half would have been right above an area that would have covered my commission, so there was no loss on it. And so usually when you close out half of a position, it's to allow you to give you a whole lot more room. So like, let's say we were up in this range. I don't know if it's going to come back down and hit this, but maybe it will continue up. But maybe it can continue down and hit this. But you let it grow. So like right now we're creating new higher highs from a previous higher low. So my expectations is that unless the bears get a hold of this trade and literally drag it down past this area to create a new lower low, we're just going to continue in an uptrend, most likely until we hit about right below 112. And then we might bounce on that for a bit and consolidate sideways for a little bit with that. So we could have been positive here if we would have been monitoring a little bit, because we were positive 9 pips. And we could have closed out half of it, had a safe 1 pip stop loss that would have been in a positive area, so right about here. Captured our however many pips. I mean, if we didn't get all 9, if we didn't see it during 9, we saw it during 7 or 8 or 6 or whatever, we can still close out half, put the 1 pip stop loss in a profitable area, and if it runs in our favor, awesome. If it comes back, it kicks us out, well, awesome, because now I don't have to worry about the trade. So I'm not upside down in that trade. So, that being said, that would be an alternative way of getting out of this sell trade back here when it was profitable for us. Now we have to address it that it's gone against us in this direction. So one of the things we have, and we're going to have to look at this, is where is that bounce point potentially going to be? And we'll go back to our charts and look at that. So let me get rid of some of these lines on here because there's just a ton of them. And as you notice, our stop loss has really moved up.
Yeah.
It's way above, oops, it's way above where we were looking at being safe.
Yeah, look at that.
Yep. So, we're up, 34, probably about 36 at the top of that little point. But we also have maybe a hard line right here at the top of this guy. So let me go to Objects List. So you right click on here if you want to get rid of your lines. Right click in here, go down to Objects List. And then you can go through, and you don't have to check the box, you can just have it highlighted, and I can just go through and start deleting these, and we'll just start deleting them all. That way I have a clean area to, again, throw up some lines if I need to. But we might have a hard line here at the top that might be right there, because we just touched it, but we're not going past it yet. We're kind of shying away from it. But we do have some decent up pressure. Alright, and according to my charts, my guess is we're going to have a continuation up for a bit, because everything is up. So I'm going to show you that on your charts, and I'm going to add a few things to your charts that are a little bit more advanced, so you can see what I'm seeing off of my charts. So, what do you want to do in this situation? Do you want to leave this trailing stop loss in place? Do you want to just put a manual stop loss where you wanted it? Do you want to put a manual stop loss where I wanted it, where I was suggesting? Would you rather close out half the trade and just put a 1 pip down here and just let it do whatever it's going to do, and just be surprised if it moves so much further up?
So yeah, from just looking at this, I would just leave the trailing in, but I know we want to let it run. But I would like to look at the charts and see what are the charts saying where the pressure is.
Okay. So we'll look at the charts here in a second, but before we do, let's address these two sell trades we have. What options do you have for these two sell trades?
Well, one, just bail out now.
Very true. You can just close them out right now.
And but then the others, I guess we can just hang on to it and hope that it reverses. That we were going to reverse. We can wait for it to reverse,
Mm-hmm.
And then either we'll take a smaller loss. I mean, it can go either way, right? If it keeps going up, it's a bigger loss. If it comes back down, we'll lose less. In fact, if it reverses completely. But looking at this, it looks like we're getting a little resistance, around 111,615 or whatever. And we're not going to be there for a while if we ever go there.
Yeah, it might be a bit, because this is a 1 hour chart. So it'll be hours, and today is Friday, so the market closes at 3 p.m. So you want to set an alarm on your phone for 1:30, because some brokerages close at 2, some close at 3. I'm not sure which one when Capital City Markets closes, because it's a newer brokerage that we're using. But you want to set an alarm on your phone for right around 1:30 to come in here and address your trades every Friday. One of the things, I have one individual, and he's just like, I trade throughout the week and I don't have a single trade open over the weekend. One of the reasons being, there are some currency pairs that have currency pairs and also commodity pairs. So there's a silver USD and a gold USD option. Over here, if you look at it, let's scroll down, it's probably at the bottom. So they're usually X. Here's your silver, XAG. AG is the periodic table thing for silver, and then AU is for gold. And so it's the silver versus the dollar and the gold versus the dollar. And what has happened is, if you're playing with very not really conservative margin levels right here, what happens is we've seen it where over the weekend silver and one of the things to do to protect yourself over a weekend, if you have a trade in and you don't want to close it out because maybe it's not profitable, it's in the negative range, is you would hedge it. And a hedge, if I were to close this trade right here, this sell right here, the top one, if I were just to hit this little X right here, which is to close the trade, the fastest way of closing the trade is that little X. But if I were to close this trade right here, these two buys and sells would balance themselves out. Does that make sense?
Yes.
So that is a hedge. That's a perfect hedge. So the exact same lot size in a sell and the exact same lot size in a buy in the same currency pair. So that's a perfect hedge. And what happens is, over the weekend, people will put themselves in a hedge like that if they're not going to close the trade out. If it's not, some people like to hang on to the trade over the weekend. But what can happen is, I've seen silver gap, not gap, but the spreads over the weekend turn into 150 pips. So right here, let's not take this middle sell, let's take this sell right here. So this one is 38.3 and this buy is 34.6 or so. So that's about $2 different, right? So about 2 pips different. So right over here you can see 48.8 and 51.5. So not almost 3 pips different. But so $4 or so, in a sense, is the difference between these two. But if I had a spread, and the spread is this right here. This is your spread. So right now you're about a 1.1 pip spread. So 78.0 to 72 or 78.1. That's 1.1 pips. That's your spread. On the weekend, I have seen silver produce a spread of over 150 pips. What that means is this here and this here, even though they're only $4 apart, the spread is going to push them so much further apart that it's going to look like, in this scenario, because these are very conservative lots, about $150 apart instead of the $4 apart.
Right.
So if you have a large enough spread and you're playing with smaller margin levels and you don't have quite the margin levels that you need, and that spread is too large, you will be margined out with a spread that's that big. So,
Okay.
being conservative is playing with pairs that don't have spreads that are that big, so usually Euro USD in a sense. Silver has had very large spreads. The other one is the U.S. Mexican peso. I've seen spreads on that as large as 500 pips.
Wow.
So that would put you negative 500, and if you didn't have the margin levels to take care of that, you're out. Even if you're in a hedge. So on the weekend, you want to be either in a hedge or you want your trades closed out. Because you don't know if that weekend, if you leave one side open, let's say we left it like it is right here, 2 sells and a buy. So we're heavy on the sells. What if this gap's 200 pips up? Like right there.
Right. Oh, wow. Yeah.
What happens if this gap's 200 pips up and doesn't come back down? Well, our heavy side is going to be, that extra sell is going to be upside down 200 pips. And the other ones are going to balance themselves out if I didn't have a take profit. I have a take profit on this sell one, which is fine because it didn't go down. It actually went up. But if I would have had a take profit, so this is actually a stop loss. So this stop loss wouldn't have been hit per se if it would have jumped 200 pips. But if I had a take profit in here on this buy, and I didn't take that off over the weekend when I'm hedged, that buy would kick itself out as soon as it gapped the 200 pips because of the take profit, and I would be heavy 2 sell trades now. And both sell trades would be negative 200 or so. So what we want to be is very, very careful over the weekends. Very careful over the weekends. To where when we're in trades, we don't want the unexpected like this, because we didn't know the French elections were going to do what they did. Because there was a potential, because there was two prime minister candidates that were the top two, and one who won eventually, he wanted to stay in the European Union. The other, it was a woman, she wanted to exit the European Union. And by the guy that actually took the larger percentage of the trades, because what they do is they have to have when they go into an election, they can have 5 or so people running an election, but you have to win with a percentage of 51% or greater. So neither of those two had 51%, so they had to go to an additional election day. So it was just the top 2 went to the next election. And so it got rid of the bottom 3 or 4 that were running. It took away their percentages and then just gave it to these top 2. So now you had to win by 51%. But he was leading the entire pack. And so what this did was it said, hey, the guy that we want that will stay in the European Union with France, he led this, and so that was very favorable to France. Very favorable in the position to where France was like, okay, and the euro surged. So if the market of the euro US goes up, that means the euro is being favored. If the market goes down, that means the dollar is being favored. The dollar is strengthening against the euro. So, for instance, this upward movement, that strength of the euro, this downward movement, strength of the dollar, upward movement, strength of the euro, down strength of the dollar, and so forth. So, what we have, at that point, you had the strength of the euro hit because the guy who was going to keep them in the European Union had the most votes. And so it swung this, because they vote on Sundays when everyone has time to go out and vote. So there's no business, there's no There's no issues with schools or work or anything else. Everyone has time throughout the day to go vote, so they vote on Sundays. And so the gap happened after their vote because on Sunday, our time about 2:45 the market starts, 2:45 to 3 p.m. And right at 3 p.m. usually the market starts, but as soon as that market started, we had a 200 pip gap from there to there. And it was because of this news of him leading the polls over there in France. And so, so for the weekends, this is something we want to avoid. So if you're in a hedge over the weekends, you take all stop losses off, you take all take profits off, you leave them blank. You will let them be, and unless you have spreads that are so severe, which you won't because you're in a very high margin level, you'd have to have spreads in the thousands to margin you out. But if we are hedged, stop losses are gone, take profits are gone, these are both clean, all zeros across the board, and we go into the weekend. And we do not leave open trades like this, open sell heavy, with the risk and the gamble that, hey, well, if I was heavy on the buys, it would have been awesome for me. But if I was heavy on the sells, I'm upside down 200 pips I got to work out of. That's not the funnest thing to work out of, because it didn't just come back. It hasn't closed the gap yet. Eventually it will, but that might be 6 months, a year later, who knows.
Right.
So no guarantees in that sense. All right, so let's look at what's happening because we're starting to get a little bit pullback.
So let me understand the idea of the hedge then.
Uh-huh.
So let's say I just have the bottom two trades. So the idea is that, okay, for example, the weekend,
Mm-hmm.
when I come back in on Monday, I'm going to be a wash. Is that right?
What you're doing is you're protecting your trades to where it doesn't matter if it gaps up or down, you're protected. The most you can lose, so if I were to close out this guy, this middle one here, and I would have the difference between these two, the top and the bottom one, I'd be about $3 or $4 negative right here.
Uh-huh.
Because I have a larger negative than a positive. So that's all that I can be negative. So if I were to take another buy trade right now and hedge this additional sell trade, all I can be negative is $45, $46. And then over the weekend, doesn't matter if it gaps up or gaps down, once the spreads come back to normal, which is usually about a pip or so, once they come back to normal, I'm around the $45, $46 range. That's the most. It doesn't matter if it gapped up 200 pips. One side's gone positive 200 pips, the other side's gone negative 200 pips, but the difference between those two stays as 45. Doesn't change.
And so do you just close out the negative position?
You can. So like, are you saying before the weekend or after the weekend?
After the weekend.
So after the weekend, we would address the negative position. Do I want to keep this hedge in place because it's something I really don't want to work out of, or do I just close? Or what you can do is if I'm just $45 upside down and I put a hedge on this, what I can do is look at, okay, well, $45 I'm upside down. Let me make some trades and earn that $45 back, and then close all these out once I have that $45 back. So I'm not losing my balance. My balance is constantly growing. My equity, would it would move back and forth. But what I'm doing is I'm whittling away with these other smaller trades the hedged portion, which is the negative whatever it might be, and then I close all the positions out. That's one way of using a hedge, to stop it from going more negative and to then whittle your way out of it with additional positive trades.
Okay.
So there's multiple ways of using the hedge. The most advanced way of using the hedge is getting good enough at reading the indicators and the market to know when I'm going to have a reversal and when I should release the positive side of my hedge. So if I'm in this and I don't have a trailing stop, and this is not here, and I just have a perfect hedge between these two. You know, this and this, these two here. What's going to happen is eventually this buy, because we're moving up and up and up, eventually the market's going to turn. And when it turns, and it might be a small turn like right here. Let's say I was going up and oh, I'm seeing a turn. My indicators are saying I'm going to do some selling. So I release my hedge. And what I can do is I can take an additional sell. So right up here. What that does, so I'm going to erase,
right.
What's that?
No, nothing. I'm just going, I'm like, aha, there's my aha.
Yeah. So I can take another sell coming down this, and it's called a price average. So let's say the difference from where we were in, we got in over here, to we saw that, okay, we can take a price average up here. So we take a sell, and this goes all the way down to, I mean, we could have gotten out of this early this morning. These trades were, these sells were positive this morning. So if we would have taken a smaller profit, we could have been out of those. Where am I? Am I seeing everything right? Yeah, okay. Yeah, we could have been out of those with just a few pips profit. Because we were actually positive on those this morning. But what happens is, let's say I have a hedge in, because I went down here and then I went positive. Okay, I hedged right above where I had taken my sell. And I moved up and then I realized, oh my gosh, look at all this pressure that's coming. So I release my one side of the hedge. So that buy trade, which is my hedge, I take another sell trade and let that sell trade come all the way down. And as soon as it's halfway, so if it's a 1-to-1, so let's say I took another sell trade just like this right here. They were both the exact same size.
Okay.
Once it's halfway to the other sell trade, I've broken even. I'm no longer in a negative deficit because one has made up half of that distance in positive and the other one has reduced half that distance in that negative, which would give me my break-even point. Does that make sense? So if I'm 10 pips upside down with a 1 and I take another sell and that sell moves 5 pips down positive, well, my other sell would have gone from 10 pips negative to 5 pips negative, and so that 5 pips positive and that 5 pips negative cancel out. So I've broken even. So what we do is we can price average down to break out of that lower sell, and on here we could even let it had gone the whole way, taken profit on that one sell that we took up here, and close out our other sell in a profitable position as well. So sometimes hedging and price averaging are very, very helpful. It's just you have to be very good at knowing where the market's going and reading the indicators and knowing that this is going to turn down. And then, oh my gosh, I see some pressure building. We're going back up. And so let's say my sell was, let's take profit. Okay, that's on that sell. Let's say that, let me do a line real quick. Let's say my sell was down here, and I didn't get out of it. And I price averaged down. I didn't close it out because I thought I was going to get close enough to it, but I didn't get out of it, and I see it starting to turn back up. I'll fetch. But what I can do is I can place another hedge. I'm this distance apart again, but what's happening is that hedge now moves up, and let's say that this was the top. And I realize, oh my gosh, we're reversing pressure right now. So I can, close my hedge out somewhere in this range if I feel this is the top, if I know this is the top. And that's the difficult part. How do you know? You've got to be really good at knowing how to read your indicators. So let's say this is the top and we got out of our hedge. I can now price average down again. And the only distance now with the price average is so from let's go from this point here to this point up here where it crosses this line. So from there to there, that line to this line, these two here to here, whatever the distance is here, because that's where I took my hedge, that's all that I'm negative. I'm not any further negative than where I'm here to here. So when I release that hedge up here, it doesn't matter how much negative this is, because this is the distance between those two, so I would have made that profit. It's going to show a larger negative amount, but I've made the profit on that other hedge to where I can add that to my price average. And what I mean by that is, all I have to move is half of this distance right here, and I've broken even with my price average if it's a 1-to-1 like this size right here. And this is very wordy, and I want to make sure that I'm clear on this. So because I've hedged and then I released it up here, all I have to travel with my price average is half of this distance, because I would take the profit for my hedge from here to this distance. I would take that profit, and then I would take the profit of this half of a distance, where my price average, I would take it up here, and half of the distance, wherever that might be, let's say it's at this, where the trailing stop line is. If I hit there, the profit I made from the positive hedge on the top and the profit I made with this price average here takes care of all of my negatives, and so I've broken even at a certain point. Does that make sense?
Yes.
Okay.
So let's see if I understand this. So I've got this negative trade.
So just so you understand, I can't see your cursor. You can see mine, but I can't see yours.
That's okay. So
okay.
Well, let's say this first sell trade that we have.
Okay.
So he's writing negative interest.
Mm-hmm.
And so the way we mitigate that, some of the ways we can mitigate it, one, of course, is just hope that it goes back down, which is, I guess it could be worth it. But in the chart, for example, when we have this trend where we start going back down, if we realize, okay, we're in a downtrend, I take an additional sell, go ahead and ride that, halfway down.
Mm-hmm.
That way, whatever I'm losing on my buy, it has not been canceled out by the profit I make on my sell. In this particular case, even though I'm profitable no matter what on the buy,
mm-hmm.
Then I can take the profit on that sell, and as far as my account is concerned, now I'm up. And then as it continues to go up and down, oh boy, now I guess I don't understand. I know I'm there.
Okay, I'm going to paint on here. So what we have is this, let's say this is our sell.
Hey, can I put you on hold for just 1 second?
Yes, you can. Hey, Kenneth.
How you doing? So my wife hung up too quick, and so when I pushed hang up, I hung up on you instead.
No worries, no worries. All right, so what I'm going to do is I'm going to show, I want this pin. Okay. So what happened was, this is my sell trade and it's going down. This is my buy trade, and what I see is, oh, this is the top of the market, so I've let this ride all the way up to here and I sold right here. Sorry, not sold. I got rid of this trade. I closed out this half of the hedge because I am very certain that this is the top and I'm going to come down kind of like this little slope that came down. So I'm very, very confident of that. And so what I would do is I would take another trade, a price average, and I would go down with this price average. And all I have to do with this price average is, because I've followed this all the way up, and now this guy is negative from here all the way up to here now, but I'm taking a price average, but this profit right here to here that I've taken with the hedge negates that this is all the way negative up to here, because the distance between these two is really only what I'm negative. The amount will be larger, showing in right over here. So this will be larger when I release this part, the top part of the hedge, because it's now going to show the full negative from here to here, but it's not going to show that profitable section that there was, because it's going to be now in my history. So if I go back to my account history right over here, I can see that, well, there's how much I made on this. So let me subtract that from what I'm now negative on this, and all I need to do is travel half of that distance in the same direction, in a short direction, so going short in the market, with this price average to eat away and break even across all three of these trades. Does that make sense?
Yes.
Okay. So literally, if I was going half of this, it would only be, a arrow in something about this length. So, something more in this range if I was to go like that. So all I would need to go was somewhere in that range, half of this distance between these two, and I would have been broke even on all of them. And so this is another way of whittling your way out of a trade in a faster manner. This is a very advanced technique, and you have to get very good at it, practicing it. You cannot just be, oh, I know, it's going to bounce here, it's going to do this. Because what happens is, what would happen if this trade, let me erase all these lines real quick. Let's just clear them all. And what happens if this trade, let's say I was in a trade right here, and then I get into a hedge, let's say it's up here, and then I release the hedge, so this one is going up, and I release it right here in this range. I'm like, okay, it's out of it, and it's coming back down, but it didn't come back down all the way, and I'm not doing, let's say I'm not doing price averages. And I'm like, oh my gosh, it's turning back up again, so I have to hedge again. So I hedge again, it goes up to here, I release the hedge, right about here, and the market continues down, but then it kicks back up. I'll fetch. I released it here, and so I'm going to re-hedge somewhere in here, and if you continue to do this when the market is moving in one direction, so let me show you some very one-sided direction on this. Let me erase all these lines that are on here. So let's go to right-click, Objects List, and I'm going to highlight one of them and just start hitting delete, and I'll get rid of them all. So let's close. Let's go to 1 day. I'm going to 1 day. Let's zoom out. You see this big long direction?
Yeah.
What happens if I'm in a buy and I keep releasing my hedge? Oh, price averaging a little bit, releasing my hedge, price averaging, release my hedge, price averaging, release my hedge, price averaging, release my hedge, price average, release my hedge. Oh my gosh, how far apart is this? We're $1.43 down to $1.06. I mean, that's 3,500 pips. That is just devastating to be in a hedge somewhere that big. And so there's got to be a point where I don't want a directional move, something that's as severe as this guy, to get me so stuck into a hedge. And so part of it is some people will hang on to these, but others, they want to get out of it, so they'll whittle their way out of it. Oops, let's zoom in. What I mean by whittling their way out of it is, I really don't want to be, let's say we're $50 separate right now. Wow. I'm going to throw a Fibonacci on this candle right here in just a minute and just see what retracement level this came down to. So it looks like it might be 50%, or maybe even 61.8. But I'll do that here in a second. So one of the things that I want to talk about is whittling away at your trade is possible. So let's say I took a trade and I made $40 on it, and these two trades right here, what I can do with that $40 is I can come in here and I can close partial trades on these two that would equal that $40 to, well, these are now smaller, and now I have to work with less. So it's still negative 50 because I took this $43 and then I closed this one out. So I took a profit of $43, and then I came into these two and I closed out a portion of both of those to get me back down to this $51 range. Does that make sense?
Mm-hmm.
So by doing that, I'm whittling away at these two. And so whittling away is a very good way of not being stuck in something that you have to continue hedging on one side, because you expect it to come back and get you finally out of the opposite side of that hedge. And if you're 3,500 pips, or is it 3,500 pips? 500 pips would be 5 cents. Yeah, 3,500 pips. If you're 3,500 pips upside down on a trade like that, it's just a nightmare, because there's so much whittling. I mean, you may have made all that money back in the price averages and your hedges, and where you release them positive, but at the same time, you're negative so much. Let's say it was, even one of these, just a sell of, 0.1, that would be $3,500 upside down. Even with this very, very conservative 0.1 lot size. So that's still negative every single time you open that your account, which is, it's negative on your psyche. It's negative on your trading psyche. I mean, there's something that messes with your mind, your mental abilities, when you see every single time you open your window, oh, I'm negative, dang it. It's just an automatic downer right off the bat, because we are creatures of emotion, and so we have emotion, but it is what it is. So are those ideas understood?
Yeah, I think so.
Because next time, I'm actually going to put this in the notes right now.
I was going to say, and for now my philosophy is don't have anything open over the weekend.
Yep.
Till I get better at this. And like he says, let your winners run and cut your losses short, right?
Yes. Yep, so this is allowing a winner to run right here, a trailing stop. Or if I was to close out half the position and putting a 1 pip profit stop. I call it a profit stop. As soon as it's in a profitable area, I call it a profit stop instead of a stop loss. Because it's not stopping a loss, it's a profit. So it's a profit stop to me. So you might hear me use that term, so don't be confused, but it's just saying, hey, we're in a profitable area. Why am I calling this a stop loss? I'm not losing anything.
Yeah.
So I'm going to put in the notes in our next session. I will ask you to explain. I will ask. Do you go by Ken or Kenneth?
Ken.
Okay. I'll ask Ken to explain stop loss, or a hedge, price average, partial trade closure, pros and cons, weekend, um, weekend practices, and then how to demonstrate the previous. Okay, so I may alter that, but it's going to be in your Slack channel. So that's in our next session. I'm going to go over and I'm going to have you explain the hedge, price average, partial trade closure, the pros and cons of all those. You're going to explain weekend practices, and then how to demonstrate the previous on all of those. How to demonstrate the weekend practices, how to demonstrate partial trade closures, how to demonstrate a price average and a hedge. So these are in the most advanced coursework. You'll get down to those. So over this next week, I want you to be able to get through, and I'm going to put homework in here. Homework. Finish all coursework and start on recorded videos under Trader Lite or on it. So, do you have your back office open?
Just give me a second.
Okay, so if you want to open that up real quick, I'm going to show you where all those fun things are, and I'm going to actually sign you up for a few different courses, or our trades. Can I ask who brought you in, Ken?
Just radio ad.
Do you know who your COD is?
Is it Trey? Is that who that is, or is it Phil?
Okay, so Trey is a representative. Phil is also a representative, and Phil's kind of like Trey's supervisor. And then above Phil is Ryan and James. They're actually the partners to the company, and Trey is the rep for them, and so is Phil. But Phil's kind of like the managing rep. So
okay.
That's your organization. But Ryan and James, really like those guys.
Okay, so what was the acronym you used?
A COD.
COD, and what is that?
Chief Operating Developer, or Chief Operating something. Director. There you go. Chief Operating Director. That's what the partners are called. So those who buy into it's kind of like a franchise in a sense.
Okay.
So those who buy.
And my COD.
Yep. So the Ryan and James.
Okay. I haven't met Ryan yet.
Gotcha.
Right. I don't know what's going on with this browser.
So let me go to it real quick and let me enlarge. Let's go to login. I can't click on anything.
Yeah, I'm going to close it.
Let's refresh it real quick. I can't even refresh. There we go. Okay, now refresh. But I'm not getting the little area to click and log in. Okay, so let me okay.
Is that maybe a team viewer?
No, I'd be able to click in here. So it's not TeamViewer. Let me try one other thing. So I'm a rep for a different COD pair, as well as a coach. But let me try theirs. So oops. Oh, not this one. Okay, so let's see if we can log in here. I can't even log in there. This is another one. This is another one of the groups that are out there.
Okay.
It's another, yeah. Let me pull it up on mine and see if I can get into it. I'm just going to direct you into it. I'm not going to have you do all this fun stuff. Are you okay using Chrome?
Yes.
Okay, sometimes Internet Explorer is funky.
Yeah, this is the Edge that comes with Windows 10.
Gotcha.
So, and then normally I wouldn't touch it, but it's like, okay, Edge 2, it works faster.
Yeah.
But like I've got Chrome already open.
Yeah, so Chrome, there you go. It logs in. I can hit the login buttons on Chrome, but I can't on Explorer. So
Yeah.
I'm just going to close down Explorer, because like right here I couldn't hit this login button. It still won't let me hit the login button. So I'm just going to close this one, and we'll just use this guy. But do you remember your username and password?
Yeah.
Okay, go ahead and throw those in. And before you hit login, I am going to bookmark this. And I'm going to do it on the bookmark bar. And I'm going to put in here FX back office. Can I put you on hold for just a second?
Yep, go ahead.
Okay. Sorry, my wife's alarm is going off, and she was already up and out of the room, so.
Oh, no problem.
Okay, so what we've done is we've bookmarked this. Let me double check and see if it took. Okay, so right there, FX back office. You can click right there and it goes right to that login page.
Yeah.
So if you want to hit login, I'll actually hit, and then I'm going to hit save on this. And the reason being, there's no information in here that anyone really can get to. It's just access. It's not necessarily information. So if it's saved, it's fine. Password saved, yeah. Okay, so if I'm here and I go to back office, it's probably going to go straight to here, but let's just, I want to make it for simplicity's sake, let's just get rid of this tab here. Like we weren't logged in. Come here, hit the FX back office, go to login. Now here's all your profile stuff. So we go to course. Here we are. Alright, so that logged you straight in from that little button right there. So I like these little saved areas, and so what I'm going to do right now is I'm actually going to add a few more to yours. So I'm going to go to, actually let's see what time it is. Okay, I got enough time. Let me look at mine, because that's the easiest way to remember them all. Okay. Actually, the email that I had was going to be the best. So I sent an email to one of the guys that I have worked with, and he asked, because he's like, my computer kind of went down, So I'm trying to reset everything. Can you send me all the links to all the different, uh, economic calendars and everything else? And so I sent an email to him with a very precise list of all sorts of stuff. So I'm going to go through those right now. And I'm going to save these. Oops. Nope. So let's go Forex Factory. So here's your calendar. Forex, there it is. So what I'm going to do is I'm going to save this page right here. This is one of the economic calendars that we have. So bookmark this. And I have it labeled as FX calendar. Oops. Okay, so I'm going to bookmark this as done. And then the other one that I want you to go, there's going to be a few of these, so just bear with me.
Just working. I'll be right back.
Okay.
Okay, I'm back.
Okay. I'm still going. So this is very telling of why the euro is up right now. So.
France is happy to be in the European Union.
I don't know. I know that I don't know. I don't know if their citizens are, but yeah.
I bet they're pretty divided.
Yeah, I would agree.
I mean, change things, but last week Poland So the European Union was telling Poland that they have to take the Syrian refugees.
Oh god.
And Poland fired back, and I wish I could say it the way they said it, but essentially they go, number one, we just took in 300 and something thousand Ukrainian refugees.
Yeah.
And that when it comes to, essentially they're saying when it comes to immigration, this is a national issue, not a union issue, and you can't make us do this.
Yeah.
It's not up to you. It's not within your purview. And so they told the union to shove it, which is what you. Anyway, yeah. So.
Well. So I'm an economics major, and I have a professor, and he's from Iran, and him and I had discussed things, after, like we just met this last Christmas, right before Christmas, and we're discussing some stuff about this war. So right now, I don't know if you know, the demographics across the world are just junk. Never before since the Black Plague have we ever had a larger population retire, and then the following generation is a smaller generation. We've never had a smaller generation following, an aging generation that's been smaller. It hasn't happened since the Black Plague. And so what we're looking at is you're seeing this demographic across the board to where all of these people retiring, there's not enough individuals to fill those positions and to maintain the economies of these developed nations. And so part of this war in Syria literally is to have refugees enter the workforces of these demographics that are just horrible. Like Germany is big on getting refugees in there because they can't take 18 years to grow a new workforce. They don't have the time to do so.
Yeah. Yeah. So they get bit by the our population is too big.
Yeah. Yeah.
So
we drain the population, but in doing so, we're going to kill the economy. So, Can I put you on hold for just a minute?
Yeah. Go ahead.
Okay. 1 second. How fast is this going to be? Alright, sorry about that, Ken.
Oh, no problem.
I'm flying out tonight to the Red Eye to New York, and the weather, we might have a flight canceled, since they were talking, my wife was talking to me about the cancellation and what we could do as alternatives, because they'll bump us around if we need to. So I might be headed to Atlanta first, and then up to New York, so not so much fun, but oh well.
Yeah.
Alright, so let's get back to saving these things. Here's the
Hey, guy, I want to ask you a simple question, just to make sure I understand it.
Uh-huh.
So a pip is 0.0001. Is that correct?
Say that again?
A pip is is it what, 1/10,000? 1/10,000th?
One one thousandth. Sorry. Let me think. So a pip is a hundredth of a penny. So
Okay.
let me show you on your right here. So if I'm looking at all of these digits, the pip on this one is the second to last digit. The very last digit is what's called a micro pip. And a micro pip is it is an easier measurement, because people were sitting here and it's like the pips don't move a whole lot, but you might have a lot of micro pip movement. So people like to see movement. They like to see what's happening underneath, instead of just one pip movements. And so they created this fifth digit to show you the additional movement moving underneath the pip itself.
Okay.
But if you go to this pair, again, it's the second to last digit, but it's in a different area, because the Japanese yen measures things differently than the rest of the world. So,
Well, not all pips are created equal then.
yes. And if you were to make money in the Japanese yen versus US dollar, the comparison, so right now you're trading at a lot size of 0.1, and you're making $1 for each pip. If you were trading this same lot size in the USD JPY at the exact same lot size, so 0.1, you wouldn't necessarily make $1 per pip. It usually is a little bit off. So,
Okay.
so other trading other currencies, there's some times where you might make the dollar, sometimes you make a little bit less. It all depends. So, like for instance, I'll give you an example of what I did last night. I'll open up my trade account here in just a minute, and I'll show you, or I'll tell you, because I was trading the Great British Pound JPY, Japanese yen, that pair, and it's a little bit of a, oops, not that. It's a little bit of a, they call it the dragon for a reason. It's a pair that can burn you, because it's a very, very, very fast moving pair. So if you're not prepared, like the Euro USD is a nice, slow moving pair that lets you, take care of things when you need to. I mean, this is awesome growth right here. So we're creating insane new highs. And we've hit the 112. So my guess is this candle in the next 12 minutes is going to push back down and stop below 112. But I'm going to look at the indicators to verify that. So for instance, last night I took a trade, and the trade made, let's see, that is a total of, that doesn't make any sense. Nope, okay. So 30.2, so 7.7 pips. I took 7.7 pips, and it paid, and this was at a lot size of 0.1. So playing around in this, I took 7.7 pips because I was on the phone with a friend last night. So same lot size as yours, 0.1, but on the Great British Pound JPY, all I made was $6.97. So,
Wow.
so, and I had a commission of a little bit larger commission, because I'm a different broker than you are. So my commission for that was, because yours is 60 cents, mine is 89 cents.
Oh, wow.
So it cost me 89 cents for that, and the commissions are different for different pairs.
So if it's Euro USD, it's for the same size of a trade, it's 78 cents. For Great British Pound JPY, it's a higher commission, at least with my broker. And then they don't pay out the same. So if I were to make, that 7.4 pips on the Euro USD, I would have made $7.40. Very simple conversion. But on the Great British Pound JPY, I made $6.92, and it was a commission that was 11 cents higher. So just different things that are out there, just for your own. Wow, that moved. Nice. Maybe we should have hedged before then. Hedged at least one of these other ones. Anyway, so let's get back to what we were going over. Oops, I need that back. Okay, so I'm still creating these for you, and again, I apologize. I just have that that flight being messed around with, so I had to make a decision. The decision was either we change flights right now, or we wait till get to the airport and then change flights, have them change us flights. So either we go there and we leave at 11:30 or so tonight and going right to New York, and they're okay with that and the plane's fine, or they say, hey, because of weather we can't do anything, we're going to bump you to this flight.
Right.
So I do have a concern. Okay, so here's another one that's sorry. So if you're looking at this right now, you're seeing the Euro USD, and you're seeing the buys and sells of these. It's not making a whole lot of sense. Why are we 80% selling on the Euro USD, but it's going up? We might have a bunch of people dropping their buy positions and going to sell, so we might see this dropping. We might see this start to drop down because the bulls are stepping in and saying, "Hey, this is 112. We don't go past 112." And the Bears. The Bears are saying we're not going past 112. The bulls are like, "Yes, we are." So you have a very uneven balance right here. So the Euro US, you have 80% of the people trying to sell, so the buyers have to be some big buyers to offset that. So then we can refresh this and it will constantly change. So it's still there. But this is another good one. So let me bookmark this. Hit done. And then one last one I believe I do have. Yep. 4x. So here we go. And if you ever have any confusion on what's going on in the market, this next one is very helpful. This literally is live information that's constantly being updated by, I'll just reload, that's constantly being updated by some of these market gurus. So as mentioned earlier, the Euro USD is in a 94 pip trading range for the week. If that holds, that would be the lowest range going back to August 2014, which is kind of sad. So we've been in a low range, and so there's been a bunch of movement right now. Next is to reach the 112.069, which is 50% of the move down from June 14th high. A move above that and the 112 high is within sights. Get above the 94 pip range is extended, yippee. So we might be moving. This is the next to reach is this point right here, and I think we've hit that.
We're already at 112, right?
We are.
I think that's what you said.
It's saying it wants to go to 112. That was the high. So 112 high is within range. So we've hit the 106. We can actually give an exact of where we're at. So let's just drop a line right on that. And so right around 112.08. So we've hit that. We just really need to stay there. We need to have it post. So in about 5 minutes, if this posts above the 12, I would kind of be surprised. But there might be enough bulls that are saying, hey, we're doing it, we're going to push this higher. But there's enough bears that are jumping on this that might be pushing it down below the 112. So we'll see here in a minute. But while that's doing its thing, let's save this one. Hit done. Let's go back to this one. And there's another really cool thing on this. It shows you this market clock. And it tells you what markets are open right now. So right now I have London, Zurich, Frankfurt, Moscow, Johannesburg, New York, Toronto, Chicago, and Sao Paulo all open at the same time. So this overlap is fantastic. That's why this time of the morning trading is very, very good when you have all of these guys overlap right about 7:30 our time. So when you have this overlap, you have a lot of markets open the exact same time. And kind of the same thing at 1 p.m. our time. You have all of these big boys, because the biggest out of them all is London. London is the king. I mean, it is. When they open, they control about 40% of the market. They place the trades to where they place 40% of the market's trades, which is fantastic. So if you're okay with staying up early, 1 a.m. is when you see some good movement in the markets. Because you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 markets open, including London being the largest. And in the morning on our time, we only have 9 markets open. So they have an additional market open. They have some of these big Asian markets that are open as well. And so it's just, it's fantastic when you see this overlap. So this is also best times to trade. This clock will help with that. So I'm going to save this over here as well. I'm just going to put 24H. Oops. Clock. And hit done. So when we go to a new tab, you have all of these available to you for information now. You can go through and start looking at these and getting ideas of all of this stuff and figuring out you know, what you want to do with all of it, and how it can help you and benefit you. And we'll go over more of that in a later lesson with more discussion. But for right now, this is everything you've got. I'm going to go a little bit over the 9 o'clock with you because I stepped out for a bit.
We're fine, because I actually have to get to work as well. So if we don't, you
Okay.
don't have.
Okay, that works. So let me wrap up some of these things. I guess we're not going to place a trade right now besides a hedge. And the reason being a hedge is I want to hedge. Oh, there's the bears. The bears pushed it down below. You've got 2 more minutes for this to post, and the bears aren't letting it post above that. So they're going to keep it under the 112 most likely. And that's why you saw when I saw 80%, if we took a sell at that point, we may have, you know, jumped on with that group. And so that's why this one, which one is it? Let's go to new tab. It was open positions. So this one right here, that's why seeing that was confusing when it was so high, but it makes sense because the bears, they pushed it, and they pushed it down, and you saw their effects, and you saw that move right there being pushed down. So, but I'm going to place another buy trade right over, so we offset this guy right here. I'm going to place it, I'll let you place the next buy trade. So you have to place it before 3 p.m. today to be hedged. I want you to have the experience of being hedged over the weekend. The thing is, if this market continues down and kicks you out of this right here, this stop loss, you're going to have to hedge maybe twice or move this up to 0.2 in a buy, because you'd have to hedge these two here because this one goes away if this hits that stop loss.
Okay.
So now you have to have an even hedge. When you're going into the weekend this week, I want you to be in a hedge. I want you to remove all take profits, all stop losses if there are any, and see we close right below the 112, literally. There it is. They wouldn't let it happen.
Yeah.
So.
So we want to remove the trailing stop loss, everything, right?
If it hasn't kicked out.
Okay.
So if this hasn't stopped itself out, and I'm guessing it might, because we're going to have probably some pullback here. It might here in the next hour. If this doesn't kick us out before you place that additional hedge later today or whenever you're going to place it, if it's now, then that's fine. If it's now, I would take everything off if you're not going to come back and look at this until 3 p.m. Does that make sense?
Mm-hmm.
Okay. So remove all take profits, all stop losses if you're in the perfect hedge to go into the weekend to protect you over this weekend.
Okay.
So
a buy hedge to balance out my extra sell. Is that correct?
Yep. You need to do one more buy hedge at the same to balance these out. So you've got 0.2 sells and you've got 0.1 buy. So I need another 0.1 buy to balance that out.
Okay.
And then once you are hedged, and if you're not going to come back and look at it, I would remove all stop losses, all take profits going into the weekend.
Okay.
And so I'm going to jump out of this so you can do that right after we get off. In this, I'm going to leave these lines, and you're going to, you can see this guy went right up to that line, stopped, and then just continued past it. So it was respected. It's just... It pierced it and decided, yep, we're going past it. And went right past it.
Probably, right.
So here's that 112 line right here that he was talking about. A hard line for our high. So that's the next resistance level that we're going to be looking at. But let's... yeah, so let's save these. Let's save your simple euro. Let's save your simple Australian dollar USD. So now all these are saved, including the chart book, so you can do whatever you want with your green charts when we get off. And any questions for me?
Yeah. How do I cancel my stops?
Okay, so right click on that line.
Okay.
So I'll walk you through it right now. Go to modify or delete order.
Make sure not to hit close order.
Yep. And then right up there underneath the stop loss area, underneath your red, that red little thing. So copy as red. So you want to just highlight those numbers and just hit 0. And then you want to hit modify button below that. And now you have modified it to where there is, and then you want to, we have a trailing stop on it. So you want to go into that, right click onto it, because it put the stop loss right back in place. So right click onto it.
Oh, it's being slow.
You're good.
Alright, there we go.
And go to trailing stop,
Okay.
and then hit none. Okay, now you have to go back in and delete that, or put in 0 for that stop loss again.
On the modify, right?
Yep.
Oh,
All right. And then you also want to get rid of that take profit.
oh.
So not a take profit in that order, but a take profit in the top sell order. So let's close this one out. And you can see this little TP right here. That's the take profit.
Yeah.
There you go. Oh, but you have to close out that order first, then you can open. Yep. Okay. So that is a little bit longer way of doing it. Let me show you one last little technique. So if I want to create a take profit point, I can go to this and it says drag to modify. I can left click and I hold on it. I can drag it down and I'm going to take profit area. Or I can drag it up and I'm going to stop loss area. So I can do either or. So if I click right there and it's in place again, instead of coming down here and right clicking, I can actually just right click on this line, oops, if I'm right on the line, and I can hit cancel take profit. And it goes away. So that's an additional way of getting out of a take profit or placing a take profit or a stop loss.
So those green lines show where I bought into the trade?
Yep. All three of these trades are those three green lines. And over here you can see each one and the number they are.
Okay.
So you can match them up if you need to.
Okay.
So all you have to do is add one more buy at 0.1 and you're hedged for the weekend.
At 0.1.
Yep. So one of the things I want you to do before next time as well is part of the homework is to finish your coursework, but come in here and start placing trades. Start seeing what things do. Start seeing what happens to your margin levels. I can create as many practice accounts as you want. I mean, you've already got 2. You can do as many as you want. There's no issues there. So let's move you into practicing all the little things, playing with a lot of these little different techniques, going back and practicing the things that we did, and not worrying about it because it is a demo account. I mean, this demo account right now is not necessarily to make money. It's to teach you how this program works. And in the process, we're trying to make profitable trades and seeing what the market does and how it reacts and everything else. But the main purpose is not to make money. Is to have losses, have losers, so that we can learn from our losers. So, well, Ken, you enjoy your weekend, and again, we're not going to be discussing anything until, and I'm also going to put in the sessions in here, when our next sessions are going to be. I swear I already had them in here, but I don't know why they're not. So we talked about having our next sessions, was it the same times as right now?
Yeah, so 2 weeks.
So Thursday, Friday.
Yeah, after the 4th of July.
Okay. So I'm going to put that in here as well in your Scout or the Slack office. If there's any changes you need to do, you can actually add a comment and say, hey, this needs to change or whatever else, and I can get to that. If you need to change anything or if there's any adjustments that you need that I wasn't aware of.
Okay.
So, but yeah, enjoy your weekend, and next week practice all those things, finish your coursework, look at the Slack 'cause I'm going to put some homework in there. Main thing is the coursework, and just learn as much as you can right up the front. Let's get all the fundamentals out of the way so we can start focusing a whole lot more on trading in the market. All right?
All righty.
Okay.
Okay, very much.
All right. We'll talk to you in 2 weeks.
Okay, bye.
Bye.
Welcome to the webinar. You have entered as an attendee in listen-only mode.
Make sure that you take time out of your day to make sure that you prepare for that meeting. Make sure you greet each person in the group. I do that every Wednesday when I do an intro. I know Jaron does as well. What we do is I'll actually, as they come in the door, I'll be there. I try to be there about 10 minutes early. So that way when they're coming in, I can greet them. I can build a relationship of trust with them. And I ask them questions up front. And we're going to talk about that here in a minute. So the reason why you want to greet each one, you may be dealing with a referral of a current member. And you might be dealing with a referral from somebody else as well. It may not even be a member. It might be somebody that's a prospect even that you met before. And these referrals are often family and friends of the member. Okay, so make sure that that you know up front who you're dealing with. Be gracious for the time they have spent to come watch. So make sure you